1 in 3 top economists now warn that the US could slip into a mild recession if new tariffs stick around. Prices are rising quietly but relentlessly, from groceries to construction materials, and the signs are starting to flash red. The question is, are we ignoring the storm on the horizon simply because the stock market still looks strong? The warnings are growing louder. According to a fresh Wall Street Journal survey conducted in early July, economists now place the probability of a mild US recession at 33% within the next 12 months. This marks a notable decrease from the 45% risk reported in April, but it is still uncomfortably high compared to the start of the year when the figure stood at just 22%. What's driving this persistent anxiety is the combination of high tariffs, volatile consumer demand, and a cooling manufacturing sector that no longer appears able to offset the strain on household budgets. Recent economic data adds weight to these concerns. The Conference Board's leading economic index, or LEI, which tracks forward-looking indicators, declined by 0.3% in June, landing at 98.8. This drop exceeded economists' expectations and suggests that the economy may be losing momentum. A mix of weaker consumer sentiment, stagnant new orders for goods, and an increase in jobless claims contributed to the decline. While headline GDP numbers remain positive, with projections for a 1% growth rate in the fourth quarter of 2025, the underlying trends hint at fragility rather than resilience. Much of the current pressure stems from tariffs that were originally meant to shield domestic industries but are now adding significant costs throughout the supply chain. As of mid-2025, the average US tariff rate sits above 20%, the highest level in over a century. This is raising prices on a wide range of imports, from electronics and home appliances to raw materials used by American manufacturers. Small businesses that rely on imported components are among the hardest hit. Many have already been forced to raise prices or delay new projects, creating ripple effects in local economies. Consumers are feeling the pain in their wallets. Grocery bills, which had already climbed during the inflation surge of 2022 and 2023, continue to rise as tariffs push up the cost of packaging, transport, and imported ingredients. A Kansas hardware store owner recently told the Wall Street Journal that they had to increase tool prices by nearly 12% in just 3 months. Not because demand was strong, but because wholesale costs jumped overnight following the latest tariff hikes. These small but steady price increases are starting to erode consumer purchasing power, especially among middle-class households that have already seen savings rates drop to their lowest levels in over a decade. Market volatility is another sign of strain. In early April, US stock markets experienced a sharp 2-day sell-off of more than 10%, as investors reacted to uncertainty over the next round of trade measures. Although markets have since recovered, the rally appears driven more by hope that new tariffs will be paused than by strong economic fundamentals. Analysts from HSBC and Barron's have warned that the market may be underestimating the longer-term risks of hidden inflation and the impact of higher input costs on corporate profits. The labor market, while still relatively strong, shows early signs of cooling. Job creation has slowed compared to last year's peak, and wage growth is not keeping pace with rising living expenses. Some sectors, notably manufacturing, logistics, and construction, have already begun trimming staff or freezing new hires. This shift reflects not just seasonal trends, but a broader caution among employers facing rising costs and uncertain demand. Even large corporations are not immune. Reports from major retailers indicate that inventory strategies are being adjusted. Some companies are stockpiling goods ahead of future tariffs, while others are scaling back orders to avoid overpaying for imports. For now, the official stance from policymakers remains cautious but not alarmed. The Federal Reserve has signaled that it will maintain current interest rates while monitoring inflation and economic growth, leaving little room for immediate stimulus. But the mood among economists is more wary. While a full-blown recession is not the base case, the probability of a soft contraction, a period of slow growth, declining demand, and elevated unemployment, is real enough to merit attention. And with tariffs continuing to act as a tax on both consumers and businesses, the path forward is anything but clear. The warning signals about a potential recession are not emerging in isolation. They are the direct result of a series of economic and policy decisions that have reshaped the cost structure of everyday life in America. At the heart of these concerns are tariffs. Once pitched as a strategic tool to protect American industries from unfair competition, they have now evolved into a systemic driver of higher costs, slower investment, and uneven economic confidence. The current tariff rates, averaging more than 20%, are the highest seen since the early 20th century, and their ripple effects are becoming increasingly visible across all sectors of the economy. One major reason tariffs are causing this much tension lies in the global supply chain structure that dominates modern manufacturing. Products sold in the US, whether it's electronics, appliances, or clothing, often depend on components imported from multiple countries. When tariffs raise the cost of these components, companies are forced to pass along the increases to consumers or cut costs elsewhere, often in labor or operational investments. This results in a feedback loop. Higher consumer prices reduce demand, which in turn discourages companies from expanding, hiring, or investing in future growth. Consumer sentiment, which is often viewed as a barometer of economic stability, has taken a noticeable hit due to these price pressures. Households are facing rising grocery bills, higher utility costs, and an uptick in prices for durable goods such as washing machines, refrigerators, and vehicles. According to data reported by the Wall Street Journal, the average US household is spending several $100s more per year because of tariff-related price increases alone. These added costs feel like an invisible tax, one that is neither legislated nor voted on, but silently drains disposable income. For lower and middle-income families, this means dipping into savings or increasing reliance on credit cards, both of which weaken overall financial health. The labor market, while not yet in crisis, is beginning to feel the drag. Tariffs not only raise prices but also disrupt the flow of imported materials that many industries rely on, from construction to high-tech manufacturing. When supply costs surge, employers often delay new projects or reduce hiring to offset the financial strain. Sectors such as automotive manufacturing, which are particularly sensitive to global trade policies, have reported declining production orders and profit margins. Even service industries, restaurants, logistics companies, and retailers feel the squeeze as the cost of goods sold continues to rise. Another contributing factor is the Federal Reserve's stance on interest rates. Although the Fed has refrained from aggressive rate hikes in 2025, it is still operating in a climate of caution. Inflation has cooled from the peak levels of 2022 and 2023, but it remains sticky in specific categories like energy and food, which are also influenced by tariffs and global supply disruptions. The Fed's reluctance to cut rates too quickly is understandable, as premature action could reignite inflation. However, this cautious approach limits the central bank's ability to counteract a sudden slowdown caused by trade shocks. Essentially, the economy is being squeezed from both sides, trade barriers on one end and cautious monetary policy on the other. Corporate behavior is also playing a role. Many companies have chosen to front-load inventory purchases to avoid future tariff increases, which artificially inflates short-term demand and distorts the data on production and imports. When these stockpiles eventually run down, companies may reduce new orders abruptly, causing a sudden drop in manufacturing activity. This cycle of hoarding and cutting back creates unpredictable swings in economic performance, further complicating forecasts for both policymakers and businesses. Psychologically, the ongoing tariff environment erodes confidence. Businesses that might otherwise invest in expansion or innovation are taking a defensive stance, hoarding cash rather than hiring or upgrading infrastructure. Small businesses, particularly those in rural or small-town America, lack the financial cushion to absorb rising costs. They are often forced to make tough decisions like cutting staff, shrinking product lines, or raising prices, which can alienate loyal customers. These trends combine to create a sense of economic stagnation that extends beyond the raw data, feeding into the broader narrative of a possible recession. Finally, Global dynamics cannot be ignored. America's trading partners have not stood idle in response to US tariffs. Retaliatory measures from the European Union and other countries have further strained export industries, making it harder for American farmers, manufacturers, and service providers to compete abroad. The cumulative effect is a narrowing of economic opportunities, both domestically and internationally, at a time when households are already grappling with persistent cost of living challenges. The result of all these factors is a delicate economic balance that can easily tip. While the official GDP numbers remain positive for now, the fundamentals, consumer spending, corporate investment, and global trade flows are all under pressure. It is this convergence of policy-driven costs, cautious monetary moves, and fragile consumer sentiment that underpins the 33% recession risk highlighted by economists. The next few months will be critical in determining whether these headwinds subside or intensify. The strain from persistent tariffs and slowing economic momentum is rippling through every layer of American society, but the pain is not evenly distributed. Certain demographics, industries, and regions are bearing a disproportionate share of the burden, while others remain shielded for now. Understanding who is most affected reveals the depth of this economic uncertainty and why economists continue to warn of recessionary risks, even as headline numbers suggest only mild turbulence. For the average American family, the economic landscape of 2025 feels like a constant squeeze. A study cited by the Wall Street Journal estimates that tariffs and associated cost increases are effectively costing households several $100s per year in higher prices on everyday goods. This includes staples such as groceries, clothing, electronics, and home repair tools. Middle-class families, already stretched by high rent or mortgage payments, are cutting back on discretionary spending, vacations, dining out, even essential vehicle maintenance. Lower-income households, with less financial flexibility, often resort to credit cards or payday loans to cover basic expenses. The result is a growing concern about household debt, as credit card balances have reached record levels despite elevated interest rates. Independent businesses and small-town retailers are feeling a unique strain. Many lack the bargaining power to negotiate better rates with suppliers, and as tariffs drive up wholesale costs, these businesses are forced to either pass the burden onto customers or eat into their margins. A hardware store owner in Kansas recently reported raising tool prices by 12% over 3 months, not to increase profits, but simply to break even as supplier costs rose sharply due to tariff impacts. These price hikes often alienate loyal customers, creating a dangerous cycle of declining sales and shrinking revenue. For many small businesses, the risk of closure is rising, especially in rural communities where consumer traffic is already limited. Manufacturing hubs across the Midwest and South are facing turbulence as raw material costs climb and international buyers impose retaliatory tariffs. The automotive industry, a cornerstone of American manufacturing, is particularly exposed. Tariffs on imported parts have inflated production costs for mid-range sedans and SUVs, pushing sticker prices beyond the reach of many middle-class buyers. Some manufacturers have begun reducing shifts or halting production lines altogether to manage excess inventory. This not only affects assembly line workers, but also the thousands of suppliers and service companies connected to the auto sector. The housing market, already stressed by high interest rates, is now grappling with rising costs of construction materials. Lumber, steel, and electrical components, much of which is imported, have seen price jumps due to tariffs. Contractors are scaling back on new projects, while homeowners face rising renovation costs. In states like Texas and Florida, where new construction drives local economies, these cost increases have triggered delays in both residential and commercial projects. The ripple effect extends to real estate agents, mortgage lenders, and property developers who rely on steady building activity. Geography plays a significant role in how Americans experience these economic pressures. Export-heavy regions, such as farming communities in the Midwest, are suffering from reduced international demand. Retaliatory tariffs from the European Union and other trade partners have made U.S. agricultural products more expensive abroad, hurting farmers who depend on global markets for a significant portion of their income. Coastal states with large ports, California, Washington, and New York are also impacted by trade disruptions, as shipping volumes slow and logistics costs climb. In contrast, some tech-driven urban centers like Austin or Denver are feeling less immediate pain, but even they are seeing cost of living increases as supply chain costs filter into local economies. While the stock market has recovered from its sharp drop in April, the underlying confidence is fragile. Many corporations are reporting tighter margins as they grapple with higher input costs. Some large retailers are stockpiling inventory ahead of anticipated tariff increases, a strategy that temporarily boosts activity but risks creating a glut when consumer demand slows. Corporate executives are signaling caution in earnings calls, noting that higher prices could dampen holiday sales and long-term growth. Employees in manufacturing, logistics, and construction are the first to feel the ripple effects of slowing orders and reduced corporate investment. Hiring freezes and shorter work weeks are quietly becoming more common in industries sensitive to global trade. While headline unemployment remains relatively low, the quality of jobs and the stability of hours are increasingly under pressure. Gig economy workers, who lack the security of full-time employment, are finding fewer high-paying tasks as companies cut non-essential spending. Perhaps the most visible sign of who is affected comes from consumer behavior. More households are switching to cheaper brands, delaying large purchases, and cutting subscriptions or memberships. Restaurants in middle-income neighborhoods report smaller dinner crowds and lower tipping rates. The pain is subtle but persistent, a kind of economic fatigue that doesn't always show up in GDP data but is deeply felt in daily life. The reality is that these groups are not isolated, they are interconnected. When small businesses close, workers lose jobs, which further reduces consumer spending. When manufacturers cut production, suppliers and service providers feel the shockwaves. The economic chain reaction from tariffs and rising costs is not just an abstract possibility. It's already playing out in towns, cities, and industries across the country. Economic trends and statistical models may point to probabilities, but the human side of this story is what gives the numbers their weight. Behind the 33% recession risk forecasted by economists are countless personal accounts of people grappling with rising costs, shrinking margins, and a pervasive sense of financial unease. These voices offer a raw look at how tariffs and broader economic pressures are shaping everyday American life in 2025. In small-town Kansas, Jim, a hardware store owner who has been in business for over 2 decades, recently told the Wall Street Journal that his store's tool prices have jumped nearly 12% in just 3 months. "We're not trying to squeeze customers," he explained. "We're trying to survive. Every week I get an updated price sheet from my supplier, and every week it feels like the numbers are climbing higher. People come in and tell me they can't believe a basic wrench costs almost $20 now." Jim's customers, many of whom are local contractors and homeowners, are buying fewer items or switching to cheaper, lower-quality brands. He admits that if the tariffs persist through the end of the year, he may have to reduce staff hours, something he has never done in his entire career. For families, the toll is equally tangible. Karen, a mother of 2 living in Indiana, shared that her grocery bill has ballooned from around $500 a month to nearly $700 since late 2024. "It's not that we're buying fancier food," she said. "We're buying the same brands, the same items, but the prices just keep creeping up. I find myself putting things back on the shelf because I'm doing mental math to stay within budget." Karen's husband works in construction, an industry now dealing with higher material costs and fewer projects. Their household is cutting back on eating out, weekend trips, and even delaying routine car maintenance to save money. Small business owners in the Midwest are not the only ones voicing concern. In California's Central Valley, fruit growers are grappling with the double blow of labor shortages and retaliatory tariffs on their exports. Miguel, who runs a family-owned farm, described his frustration. "We've always relied on selling a portion of our produce to Europe and Asia. Now those markets are charging extra tariffs on American goods, and we can't compete. I had to leave a portion of my orchard unharvested last season because it wasn't worth the cost." For Miguel, these losses don't just hit his business, They also mean fewer hours for seasonal workers and less money circulating through the local economy. The voices from the manufacturing sector are equally sobering. At a mid-sized automotive parts plant in Ohio, workers have reported that management is reducing overtime shifts and putting hiring plans on hold. Jake, a machine operator at the plant, explained, "We used to be busy all year round. Now the supervisors say orders are slowing because the cost of imported materials is eating into profits. We've had fewer shifts in the last 2 months, and people are worried this is just the start." His comment reflects a sentiment echoed in many blue-collar communities, the feeling that economic stability is slipping, one policy change at a time. Even service industries are beginning to feel the pinch. Rachel, who runs a family diner in Wisconsin, says that the rising cost of food has left her with no choice but to raise menu prices. People are already sensitive to higher prices, and we've seen regular customers come in less often. They still want to support us, but I can see it in their faces when the check comes. They're tipping less, ordering less, just trying to stretch their money. Rachel's story highlights the way tariffs, while aimed at imports, end up seeping into nearly every sector of the economy. From a financial perspective, investors and analysts are also sounding alarms. Matthew, an investment advisor in New York, warns that the markets are being lulled into a false sense of security. "We saw a sharp drop in April, but then everyone jumped back in when they thought the next round of tariffs might be delayed. The fundamentals haven't changed, though. Corporate margins are thinner, and consumers are maxed out. We're one bad quarter away from a confidence shock." His warning reflects the unease that even Wall Street professionals feel, a recognition that stock market rallies can mask underlying weaknesses in consumer spending and business health. These voices illustrate the emotional weight behind the economic story, a mix of frustration, caution, and anxiety that is hard to capture in a single data point. People are adapting, but often by making painful compromises, cutting hours, delaying investments, tightening budgets, or letting opportunities pass by. The sense of resilience is there, but it is overshadowed by a lingering question. How much longer can these communities withstand the strain before something breaks? The American economy stands at an uncertain crossroads. On paper, growth is still positive, unemployment is relatively low, and consumer spending has not collapsed. Yet beneath these surface-level indicators lies a fragile reality defined by rising costs, wavering confidence, and a series of structural shocks that show no sign of easing. Tariffs, which were meant to strengthen the economy by protecting domestic industries, are now functioning like a slow-moving weight, pressing down on household budgets, small businesses, and industrial output. The Wall Street Journal's 33% recession probability might not sound like a guarantee, but it is high enough to demand attention and perhaps to spark unease. What happens next depends not only on policy, but also on psychology. If consumers begin to pull back sharply, fearing higher prices and economic uncertainty, that caution could become self-fulfilling. Companies would respond by cutting investments and reducing hiring, which would in turn dampen consumer confidence even further. Economists call this a feedback loop, but for families and businesses on the ground, it would simply feel like a slow tightening of financial constraints. The pressure would be less dramatic than the sudden collapse seen in past recessions, but perhaps more draining because of its persistence. The global context adds another layer of complexity. Trade tensions are not confined to US policy alone. Retaliatory tariffs from Europe and Asia are hurting American exporters, from soybean farmers in the Midwest to technology companies in California. A shift in global demand or another geopolitical shock could easily tip the balance. Meanwhile, the Federal Reserve remains cautious, hesitant to cut rates aggressively for fear of reigniting inflation. This creates a narrow and uncertain path for the economy. Any wrong step could tilt the country into contraction, even if only for a short period. For ordinary Americans, these macroeconomic forces translate into everyday dilemmas, choosing between paying down credit card debt or affording fresh produce, delaying car repairs to cover rising utility bills, or wondering if it's still safe to take out a home loan. The resilience of households and small businesses has been tested repeatedly since the pandemic, and now they face yet another cycle of economic uncertainty. Some will adapt, others will struggle, and many will simply hope for relief that never seems to come. There is no clear resolution to this story, no single point at which the clouds will part and stability will return. Instead, the economy is likely to move through a prolonged period of adjustment, one shaped by policy decisions, consumer behavior, and the unpredictable rhythms of global trade. Whether this adjustment results in a mild slowdown or evolves into a full recession is a question even the most seasoned economists cannot answer with certainty. Perhaps the real question is not whether a recession will happen, but how prepared Americans are to weather yet another test of economic endurance. Will this era of tariffs and price pressures reshape the way the country thinks about trade, growth, and the role of the global economy? Or will it simply fade into the next cycle of headlines and market swings, leaving behind the quiet struggles of households and small businesses? The answers remain as uncertain as the months ahead. America's economy isn't collapsing, but it's under pressure. The kind of pressure that creeps in quietly, one price hike at a time. We've heard from the families cutting back, the small businesses barely holding on, and the experts warning that a mild recession could still be just around the corner. As tariffs continue to shape our daily costs and global trade remains tense, the question is no longer if this will affect us, it's how deeply it will change the way we live and spend. We'll keep tracking every twist and turn right here. Stay tuned, stay informed, and ask yourself, are we ready for what's next?